Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. Today, we're joined by Sarah Ketterer, CEO and Portfolio Manager at Causeway Capital Management, a firm she co-founded in 2001. Causeway manages $68 billion as of the end of March. Today, we're going to explore her perspective on global value investing, leadership and culture inside an employee-owned firm, and the major forces reshaping today's markets. Thank you for joining us, Sarah.
Thank you for inviting me, Alex. And by the way, it's 70 billion.
70 billion, growing very fast. Congratulations. Let's start with a little background. What were the earliest influences that shaped how you think about risk and decision-making, perhaps long before you ever even managed money?
This question takes me back to the summer between my 2 years in business school. So I was in graduate school and I needed a summer job that I thought would propel me into the stratosphere. I just didn't know which stratosphere I wanted to be in. Curiously, I ended up on the equity block trading desk at Jefferies in London. And I was the only woman on the desk who didn't serve coffee. But what was fascinating was the work that they did between agency and principal trading and taking risk and moving huge blocks of equity very quickly and taking as little risk as possible or knowing when to take it. And I found that all jaw-droppingly fascinating. I didn't want to be in trading, but I definitely knew I wanted to be in equities.
And you originally saw yourself on a very different path. What changed your mind, and what did that pivot teach you about choosing the right kind of work?
The old aphorism, do what you love, it definitely applies. When you're very young, I think you have to experiment if you don't already know what it is that gets you out of bed in the morning, because it can't be the money. It has to be because you enjoy, you find fulfillment, you're just energized by the work you're doing. And I floated around. I've tried investment banking, which I found very not energizing. And when I got to asset management, I knew that was the right place.
Yeah, oftentimes, I suppose when you're younger, you don't really know what is out there in the universe. So what you said, I think, makes a lot of sense, which is you have to try various things, get exposure, and try to broaden your horizons because you may not know what you're passionate about.
Yeah, I would totally agree. And even in a world that becomes highly automated, the same applies. Nothing about that changes because others can explain what they do. You can go to all the informational coffees you want, but until you roll up your sleeves and dive in, it's really hard to know what you are going to think about it.
So looking back, what would you say was the most formative failure early in your career that later proved to be an advantage?
I fail kind of consistently. Like every several years, I find something else to fail in. And given that I've spent all of my career in human capital businesses, the biggest failure I've had was hiring the wrong person for a role where I didn't kick the tires enough, went with a brand name and found the organization rejected that individual. And that sort of lesson is unforgettable because collegiality and cooperation is so important. And if somebody comes in with an ego who isn't cooperative or collaborative, or even worse, isn't even productive, the resentment rises very rapidly and can be culturally incredibly damaging. And the only way to get out of that problem is to realize I made a huge mistake, and then terminate that person's employment, pay whatever you have to pay to get rid of that individual, and move on and never do it again.
You know, what we said earlier in terms of the individual trying to find what they're passionate about and potentially what they're really good at. And so as on the management side, you're also trying to help them find the right role. So obviously it needs to be something they're passionate about, something they're good at, and fit culturally. So it's a lot to try to navigate.
I'd even add to that people change in a long career where you want the continuity of the same individuals working together, maturing together, becoming more intuitive about the work they do. They don't remain static. Actually, I think that's good. But as they change in their own personalities and their characteristics alter over time, we have to make sure that the work does as well. So it's not, and I learned this through my own experience. One's job description changes in a very, very long career, and it should do, and it should adapt so that there is succession and the organization's well suited for people across different roles to take up some of what, for example, I have been doing and give me new areas of challenge. And that, I say that's true for all my colleagues, not to typecast them. And I think about how is it after, say, a decade that the other senior people and I can figure out how to energize them and give them something that is new and different and yet exploits the skill set they already have built.
When you co-founded Causeway in 2001, what problem were you trying to solve that you felt existing firms were not solving well enough?
Nearly 25 years ago, the world of asset management was quite different. It was much simpler. And international equity, the investing in stocks listed in exchanges outside the US was still pretty nascent. And taking a value approach there was pretty new. So everything we were doing, we started off with carrying over our international track record. Our first client at Causeway hired us for global equities. We had to pick up the US market, which turned out to be absolutely essential anyway. We were bringing just the discipline of not overpaying and understanding management teams and putting as the highest quality businesses for the lowest price, that sort of optimization in the portfolio. And then really importantly, Causeway from its infancy has always believed in the combination of fundamental and quantitative research. Long before we began Causeway, the founders of Causeway, we realized that we're much better off with quantitative risk control in our portfolios because we can't really measure systematic or market risk without having a multi-factor risk model. And then we learned so much more from our quants and got tremendous toolkit on timing of trades and emerging market macro and sustainability factors. It's been a great journey. So there wasn't much of that when we started. And I think, curiously, there still isn't much. That fundamental and quantitative are often housed separately, even if they're under the same firm name. And we think they belong very much together.
Yeah, I guess some people think of it as two different frameworks or mindsets. And I guess there are pros and cons to each. And if you can combine them, maybe you can get the best of both worlds.
It sounds like an ad, best of both worlds, but it really is. I don't think our quantitative colleagues at Causeway who manage our emerging markets, our global systematic, our international small cap, and now global small cap, they rely very heavy on statistics and lots of extrapolation of events that have occurred in the past into the future. And fundamentally, we will take past events and maybe come to a very different conclusion about the future. We don't have anywhere near, in fundamental research, the breadth of our quantitative colleagues. We don't cover as many stocks, but we can look around corners. We understand features of industries and what may be either threatening them from a disruption perspective or benefiting them that our quant colleagues don't have. It's not in the data yet. It's something that we're forecasting. We fundamentally very useful as a risk control for our quantitative colleagues. And they, as I mentioned earlier, are essential for our fundamental portfolios because otherwise we would have no way of knowing how to diversify and how to ensure we're not overly focused on any one or two risk factors that could end up not serving our clients well.
So one topic we briefly talked about earlier is culture. So when you launched Causeway, what did you decide was non-negotiable about culture from day one? And what did you learn you could be perhaps more flexible about overtime?
Absolutely non-negotiable is integrity, the honesty and the level of trust and between us and our clients and our entire team. Performance is essential for a great asset manager. Absolutely essential. We call it the top of the food chain, but it goes hand in hand with the integrity of the organization. And anyone or any operation or any process that we have that isn't of the highest integrity, we reject. And we've done so from the start. And I think flexibility, maybe it's location. We used to insist that everyone was in the same location except for some of our business development / salespeople. And I'm not as concerned about that. I think the way people communicate and convening and then going back and that's fine. We've got a research colleague in Shanghai, so she's definitely far from the mothership of the LA headquarters office, and yet she comes out for a couple of weeks at a time and communicates extremely well, and has proved that we can have people in faraway time zones. They just need to be in touch as opposed to isolated.
I suppose it's easier to be in touch these days with technological innovations and tools than maybe it was 30 years ago.
Oh yes. Oh, much, much. This it's funny. I every once in a while glance at my office phone and wonder if it's ever. I know it rings sometimes. I never pick it up. I don't even know what the point of it is.
It's true. Yeah, it's so interesting how I guess these things can change slowly for a while and then they change very rapidly. And I just feel like you've had pretty rapid change the last maybe decade or so.
We had a great client service team, and we were pre-COVID talking about how we can get more interaction with our clients. And then, of course, everything shut down during the pandemic. But it did lead to this hybrid type of communication. And it's good. I think we get actually more client access. They come to see us in person, we'll go see them. But as opposed to doing a conference call, which is it's only voice. You only get one dimension. And now all of that's been replaced by video conferences, so we can at least see the clients and re-cement that connection we have with them visually.
Right. And I'm sure ultimately we'll get to a point where you can deliver a message through video and some people join live and some are replay. But then you can also make it interactive where there's questions asked, there are answers in the response, responding to frequently asked questions. Even maybe AI can get involved and answer some questions for people. So it could certainly become even more interactive.
I agree. I'll admit I've done a few calls where not with clients, but research related, where I was also doing AI queries on the side, just to sort of supplement what I was hearing. And it's fantastic. That's all I can say. For professional question askers, because I started as a research analyst, AI is phenomenal. Not only just reinventing processes and becoming more adept at getting through just mountains and mountains, endless amounts of data, but the ability to get answers quickly and then get the sources and think about them some more just launches, I think, all of us who are doing investment research into a whole higher level of understanding of the businesses we're investing in.
Yeah, and as a firm that's had a quantitative perspective for 25 years, you also have a lot of proprietary data that you could potentially use that could create an edge long term.
No, you're right. And much of that comes through company meetings. So from a fundamental perspective, it's this interaction with C-suite or investor relations or our global consulting network of experts, like whatever we can get. This morning I did an AI search through podcasts looking specifically for mentions of the SaaS apocalypse and understanding what some experts are saying. We can get just about any information we want anywhere, and whether we originated it or it's someone else did. We have transcripts from other firms' outreach to expert networks as well. Information is never, and I believe will not be in the future, the issue. It's about what we do with it and how we think about what it is that we're seeing and understanding. And this is where having agents working for us, scouring through information and refining what it is we want to look for so that we're not overwhelmed. I don't think there's too much information. I think there'll only be more. It's just how are we understanding it? And then quantitatively, we just relish having more information. More data is more opportunity to look for signals.
So, one thing that I think is interesting about your organization, in contrast to many others, as many investment firms drift into a star system. What is your perspective on that, and why do you feel it matters for long-term outcomes?
We built Causeway, and then I'm referring to Harry Hartford, my business partner and co-founder, along with Gracie Familia. So Harry is our firm's president, and she is our chief operating officer. We knew from the start we wanted to ensure that we didn't concentrate the talent and the attention on any one or two people. And Harry and I spent years diminishing our perceived role so that we could bring others into the limelight. And we've looked at other firms. We've seen how they are instantly associated with a person. And that's a lot of business risk. It's also, I think, not good for clients. I think clients benefit from, especially in a discretionary or fundamental portfolio, the thinking of a number of different portfolio managers, not who have a sleeve or an assigned portion, but rather have expertise in sector or sectors. And when his or her stocks are finally, they're trading at a low enough price, so there's sufficient return and the risk level is attractive. So on a risk adjusted basis, these stocks rank higher than the others we have to consider. They'll have quite a significant influence in the portfolio. And as their stocks do well and the prospective return diminishes, their stocks will descend in the ranking and will own less of those and recycle proceeds into higher ranking stocks. So with 6 primary fundamental portfolio managers, the most senior people we have on the fundamental side of our business, sometimes 1 or 2 of them are very prominent in the portfolio, and as their stocks perform well, we may own less of what they have, and then others will end up having a more significant influence. And given that every portfolio manager, no matter what anybody says, everyone is born with behavioral biases, I like the fact that through our construct, not only are we diversifying portfolio holdings, but we're diversifying decision making. We're diversifying the biases that inherently individuals bring to the portfolio.
So let me ask you some questions about value investing. How do you define value in a way that still holds up as markets evolve and investor behavior changes?
Low price to book value, low PE ratio, all the criteria the indices use. And that lasted a very brief amount of time. And then it became clear that a lot of those very cheap stocks are cheap for a reason. And as we started Causeway, we recognized that we needed to do much more than just define value as cheap, but rather sometimes the stocks that we think are value stocks aren't ostensibly cheap. They may look expensive because they are what we call under earning, where due to cyclical reasons or a setback of some kind, the company isn't delivering earnings to its potential. And the multiples may seem high as a result, but in fact, there is an opportunity for the business to deliver much better earnings in the future. And all of that, from a fundamental perspective, crystallized during what we call value winter, when interest rates were 0 or negative in many countries around the world and went to 0 in the US. That was brutal on value managers because we think of every stock as the present value of all the cash it can generate into perpetuity, discounted to present. And if the discount rate is 0, then there is no there's no greater utility in having cash today versus cash tomorrow. So return of capital, like dividends, I used to talk about dividends, and people in that period of time, like 2017 to about 2021, they'd look out the window. I'm pretty sure that they looked at me and thought fossil, but because cash was trash. That was a time when we fundamentally had to reinvent value, or at least tailor it to where no matter what the rates environments would be, we could deliver returns to clients. And that's when we leaned in, and although we'd already had some experience with it, into what I call active value, where we fundamental are encouraging our portfolio companies to manage their business better and to improve both revenue growth, margins, earnings, cash flow through ways that managements, they often know what to do. They just need sometimes a kick in the shins. And this is particularly true outside the US, where there's much more value than in the US market. And as we think about value as that unfulfilled full earnings potential. And that's one of the reasons why in a global context, we tend to be underweight the US market. Not that the US market isn't phenomenal, but if you're using a value approach, an active value approach where we're encouraging management teams to be more forceful in their delivery of results for shareholders, the opportunities outside the US seemingly endless. And couple that with an actual trend toward improved corporate governance across most of our markets, and most strikingly in Japan, has made this active value approach for us very effective. So we call it operational restructuring when companies are engaged in some type of self-help, where it's not just that the cycle's turning up and they'll finally be successful again. It's because they're doing something to ensure that their business is really well situated for either a product cycle improvement, a business or economic cycle improvement, or whatever the specter is that was weighing on the share price. It could be litigation or a poorly executed acquisition. So there's so many reasons why there are setbacks. But we think about these companies, what should the share price be worth 2 years from now? And it takes typically at least 2 years for these operational restructuring plans to be fulfilled. So that's how we think about value. It's active, it's exhausting. And that's why we charge fees for this, because we're not just buying cheap stocks. You can do that in an index for mere basis points. And this is very different. Quantitatively, we think about value as specific criteria. And that works very well in the context of multi-factors, array of other factors, including growth and size and momentum and volatility and cyclicality. But fundamentally, we have to make our own catalyst. And I make it sound easy. It's really hard.
And obviously, it also requires patience. So how do you decide when patience is a virtue versus when patience turns into stubbornness?
This is difficult to answer because every situation is different. And sometimes a company will be executing. The management will be delivering the efficiency and cost cuts, the revamping of the supply chain, whatever it is they were going to do in order to make the business more profitable. And then something exogenous happens, some tariffs, a war, you name it, that sets their back. We can be patient then because we recognize that the setback is transitory, and yet the management team is efficacious. If we see procrastination, if we see management who expressed an interest in generating free cash flow and returning to shareholders, and then all of a sudden decide to make what we consider to be a shareholder value destructive acquisition, we lose our patience. And those are extreme examples. There's just so many examples. Sometimes we're too patient, and that's when, again, in the collaborative team environment, as portfolio managers, we will question each other in a very professional way. Why do we still hold that? Is this management team really committed to doing what's necessary to deliver for clients? And that's like holding a mirror up sometimes to the portfolio, and that might spur an action. But it's a very delicate situation because we can lose patience as clients can with us in a down cycle for value. And then just as we sell, the improvements start to materialize. So there is no overall statement I can make that applies to the portfolio, except each situation is different and requires a lot of thought and a real understanding of where the management team is in the process of operational restructuring.
I can imagine there's also a challenge where you see the actual improvements that are made on the ground, whereas the clients see the price and they see the returns. And sometimes it takes a while for the returns to catch up to the actual fundamental improvement. And so you may need additional patience for that connection.
Clients, Alex, want consistent performance. And I think that's a little easier to deliver quantitatively, where we're tracking error constrained and the portfolios don't deviate massively from benchmark, and particularly in emerging markets where things can go terribly wrong from a macro perspective. But it's very difficult if you are a style manager, meaning in our case, value from a fundamental perspective, to deliver a consistent performance pattern. The performance tends to be very lumpy. And the reason why is because we, as a portfolio management team, are near incapable of staggering the payoffs from the portfolio holdings. Let's say there's roughly 65 stocks in an international portfolio and 55 in a global portfolio. We can't stagger the payoffs evenly because we don't really know when they're going to happen. We think we do, and we're often wrong. We get to the payoff. We don't necessarily get to it in the time frame that we expected. And it could very well be that we go through this 2-year period where all these companies are doing poorly in the process of taking on new management teams or implementing some sort of restructuring plan, or just their industry is just cycled downward and hasn't turned up yet. Demand hasn't picked up. Clients get restive. They don't like it, and I don't blame them. And yet, if we were tucked away in an LP somewhere, they wouldn't even see it and think they'd be delighted. But mark to market, Monday to Friday, is a real challenge. Public equities are considered to be the most liquid and therefore expendable. We're often used as a source of cash when clients need money. But we're engaged in a process with our portfolio companies is, I think, quite intense. Maybe not private equity intense, but not too far away from that for many of the companies in the portfolio, because that's what it takes in order to, in a very efficient global marketplace, to get from where we are today, where the market doesn't like the stock, to where the market sees what we saw a year ago.
And also, many clients may become overly benchmark sensitive. And so you talked about having, low tracking error to a benchmark, but you also constrain your potential value add by doing that. And if you're trying to add more value, you may have wider bands around the benchmark, and that can also create challenges for clients holding on for the whole ride.
I agree, and especially in emerging markets where macro is so important. So that's why quantitatively we're very careful to work around bands. In developed markets, that's generally less of an issue, the country risk, because so many of our companies are globally competitive, and their country of listing often isn't even where they do any business at all. So their economic risk is elsewhere. We recognize the benchmark has its weights. From a fundamental perspective, and emerging and global value, we work entirely from the bottom up. So the stocks compete with each other, and our risk model keeps us diversified. And if it turns out our portfolio looks nothing like the benchmark, which is most often the case, clients have to understand that. If they want something that looks like the benchmark, then they need to choose a different strategy. We have a global systematic that's much closer than what we do in global fundamental.
When you evaluate management teams, what do you listen for that rarely shows up in earnings calls or investor decks?
We want to know that management has skin in the game. And this is a very accepted practice in the US. In fact, taken entirely for granted that management teams are totally motivated by total shareholder return, including the share price itself. That's less the case outside the US, much less, albeit it's improving. And it isn't just financial skin in the game. We want them to be reputationally tied to the outcomes that they're going to deliver for shareholders. So that I think it's in my book, it's number one. I want to make sure, because we're not running the business, they are, that the management team is aligned, and it has to be far more than just lip service.
Yeah, and you can listen to what they say, but you also need evidence to back that.
Some of our best investments have been with a more senior CEO or CFO brought in, and it's his or her last job, like early 60s. This is it. This is reputationally the capstone of their career. And they're just phenomenal. Like they already have an incredible track record. So they're capable. But reputationally, it's so important for these individuals to leave this legacy that it's just very exciting to invest alongside.
That's really interesting because you're looking at it from a real world perspective and you're thinking about the motivations and the capabilities of the people leading the charge. And so you're thinking about it from, in some ways, like a behavioral perspective rather than what you can just find in the data.
I think people justifiably, especially senior management, they have egos and they want to protect them and they want to know that their career finished as, with this in the penultimate fireworks of success. There's no way they want to go into the history books as having sunk the business. I'm being a little extreme, but complacency disappears when it's the last chapter. They go for it.
Right, because this is a way for them to demonstrate all of their learnings throughout their career and bring it all together to have, one last great success before they sail off into the sunset.
I think so. Their situations all are slightly different, but I don't mean to say that there aren't great, much younger management teams as well. It just this is sort of a judgment call, but it does help us fundamentally to understand where that CEO has come from and what he or she has done in the past, because it de-risks for us the bet we're taking. That person is clearly capable, maybe in a completely different industry. They could have come from autos and now they're in luxury goods. But if they know how to run a business efficiently, that's 3/4 of the way there.
You highlighted earlier that you often invest in companies experiencing temporary setbacks because you can find value there. How do you think about resilience and what allows a business to survive the trough without losing its long-term trajectory?
Well, resilience, even though the business itself may be struggling, comes from the balance sheet. And if we ever get into trouble, fundamentally, it's because we underestimated balance sheet deterioration. Because what we don't want to be in a situation where the company is facing all kinds of operational headwinds and the business isn't growing, might be shrinking. They have management's restructuring. I mean, it's going through a pretty serious operational changes. And so there's operating leverage and then there's financial leverage too. That's usually quite toxic. So we look carefully to make sure that there is plenty of interest cover. If we can be in a net cash position in the business, even better. If there are assets to sell, if there are non-core assets that the company has that could be divested if needed, although maybe not ideal in a time-pressed kind of environment, but it creates a little bit of safety for us. So that's if we make mistakes, it's because we underestimated how rapidly the balance sheet would deteriorate. And where we've been successful have been situations where the balance sheet starts to improve dramatically, which has been great for the equity, and or the balance sheet was so strong that the company could engage in some very significant restructuring, and the business could be under a lot of duress, and yet no concerns about ultimately rewarding shareholders, because if they're debt holders, they get paid first and based on the capital stack. So we want to make sure that there's ultimately, as we see in banks for bank stocks, when they no longer have to reserve in any over reserve, and their cost of risk falls, and the regulator gets off their back. There's a lot of money for shareholders, which is great, and the market loves this.
What is the most common behavioral mistake you've seen even sophisticated clients make when a style, a region, or your strategy goes out of favor?
The most common is extrapolating the present into the future. 90% of the clients I've ever worked with in my career do this. I think 90% of investors do this because what we see, the present, so compelling. Right now, this is what's happening in AI, and this concern about software as a service stocks, SaaS stocks, being put out of business, or certainly seeing their growth rates diminish rapidly, because we have so much evidence that this is going to happen. But we also have increasing amounts of evidence it won't happen, or not in the way that seems likely today. So the extrapolating the present isn't, we can explain all we like to clients that, look, this environment, this really difficult environment for these companies is just a cycle. But cycles get forgotten. People really like linear. They very much think along those lines of everything is different this time. And it almost never is.
This is something that I think about a lot because I see it as well from the advisory side. And I think part of it is that most of the world actually does work linearly, meaning past performance is indicative of future results. You have an employee who's a strong performer in the past, they'll probably be a strong performer in the future. But markets can be very different, right? They tend to be cyclical. It's past performance. Even the warning is past performance is not indicative of future results, but that warning often goes ignored.
Well, it's very pertinent to the markets today because there's so much momentum, and it's U.S. market is so extraordinarily, it's along with a couple of Asian markets, so incredibly concentrated in very specific in this AI transformation. And there's a lot of credibility there. There's a lot of infrastructure spend, as we know, but there are other parts of the market that have been just completely left for dead, as if they will never, ever see the light of day, would never recover, not see anything that looks like earnings growth. To the value manager, that's sort of interesting. The flip side of concentration is what's left, the long tail. So I think as long as people and investors continue to extrapolate the past into the present, that gives us, from a fundamental value perspective, an opportunity. That's one of the great inefficiencies that lurks in markets.
And you saw it firsthand when you launched your firm in the early 2000s, where you had a narrow market, the internet stocks at the time, and the timing couldn't have been better in terms of when you went live.
Our timing was excellent, and it was particularly helpful to have a few years before we hit 2008, which wasn't.
Yeah, so you talked about interest rates earlier. So as interest rates change the cost of money in a meaningful way, what becomes newly true about valuation and what becomes newly dangerous?
Zero rates and negative rates are dangerous, and they don't help our quantitative colleagues either. There's nothing about investing where a zero risk-free rate makes sense. Nothing. And that situation is an indication of a very unhealthy macro environment. And the other side of that, coming out of that, as we've seen, is a tremendously large central bank balance sheets, a lot of fiscal strain, huge amount of monetary liquidity, so lots of asset price inflation. I can't imagine we're going to return, whether we're referring to the US or Europe or Japan or any other of the developed markets, to that environment, because inflation has returned, but it was really difficult. There just can't be an environment where risk-free rate is nothing. It doesn't make any sense. It's incredibly perplexing, and it encourages so much speculation because, as I said earlier, one isn't different between cash today and cash 5 years from now. I mean, there's just this idea that there's no cost of money. Now we've been several years into our inflationary higher rate environment from March of 22, and this, everyone thinks is totally logical. But if you roll back, even in the COVID years, nobody was talking about rates. I mean, it didn't. Why have them? We were all about modern monetary theory, and governments could spend all they, at least those who had their own sovereign currency, as much as they wanted. Not the case. So rates, especially positive real rates, very useful from a value perspective. We know what sort of cash flows we're working with. We know how to calculate our discount rate. We have a pretty good idea of the weighted average cost of capital of the business because we know what the business's risk profile looks like. And we can work with the tools as opposed to be cast adrift.
So, in that regard, how do you think about the long period of fiscal deficits, rising government debt, and highly accommodative central banks? And do you expect the future to differ materially from the past?
Looking at clues from voters and elections, it appears that there's, at least for now, voters seem to want to have, or the same, lots of fiscal intervention. They want it. I think that the strain that's happening in Europe now is indicative of this, in these aging populations that have had a kind of organ rejection against too much immigration. The welfare spend is enormous, and yet the GDP growth is pitiful, if even present, and it's not sustainable. That social welfare spending at that magnitude is not sustainable. And there is also a very significant infrastructure spend required ahead. Lots of spend on green energy, not to mention defense and energy. I don't know what the Europeans are going to do, but I had to guess is that voters will end up recognizing that they need to invest in the future, that can't have it all today. And that to me is the trade-off. Is voters in democracies, are they going to expect that, are they going to raid the bank entirely today or put some money away for the future? And that takes great leadership and government officials who can explain that articulately. So we'll see. That's what I would like to happen. The worst case is much more in the way of wealth inequality and gap and resentment, and what will be, unfortunately, some real setbacks to GDP growth, with a lot more in the way of redistribution and less in the way of investment. It's investment that's so desperately needed. And at present, at least in the US, a very significant portion of capital expenditures going into data centers and related ecosystems. But for the rest of the world, they have that plus everything else they need to do. And all of us face the need for better grid infrastructure and much improved energy generation and distribution.
And oftentimes, when it comes to policy, the status quo could remain. And one of the factors that could change it is the markets. And you can look at things like inflation, where it's starting to push back on, these massive deficits. So I think that'll be interesting to watch as well.
Yes, the inflation is a miserable tax on lower income, and we've seen asset price inflation for years now. Central banks from 2008 have been very accommodative, with the Fed leading the pack. Consumer price inflation is horrible, and we need a little bit of it, but beyond 2%, it starts to eat away. And when people have negative real incomes, they become very resentful. Either they get the increase in wages that they need, or they look to vote for some alternative. And this is we're facing this in the West in particular. Well, I'd say facing it in Japan a bit too, where there's some reluctance to raise rates, which to quell inflation, and there's a fair amount of negative wage growth there, real wage growth there as well.
Yeah, so you have growing wealth and income inequality, rising inflation pressures. It seems like we don't know when the inflection point is, but it seems like we're getting closer to the point where a policy will have to change.
Yeah, perhaps. This is where the future gets very murky. And our team at Causeway, from a fundamental perspective, we're having an offsite just to think about how this massive technological revolution with AI at the forefront will impact not only our portfolio companies, the industries and the sectors that we invest in. We thought about it from our own perspective because we may be in a really difficult, and I mentioned this as society overall, environment where there's some job displacement. So people who are fired from one job, but then maybe hired for something else. But in that interim, it's highly uncertain. Our education system may not be keeping up with the needs for hiring. I think that's probably very likely. And that, again, creates a very angry electorate. But will this prosperity that comes from all this productivity gain that we're promised in the future get here soon enough to mollify a very angry voter? I don't know. And that's why balance sheets are so important. I mean, because there could be some rough seas. Cash flow. Keep looking for that cash flow wherever you can get it.
As AI accelerates access to information for everyone, what will still differentiate great investors from just the average ones?
There's so much we'd like to automate. There's so much of information gathering and assimilating and organizing a research agenda and stripping a company down to its bare bones and determining an investment thesis that's durable. And yet there's that extra, that's something else that really great experienced portfolio managers and senior analysts bring to a fundamental discretionary research process that can't be replicated by AI. I try to think about as all the AI masters speak on these podcasts about how incredibly even more intelligent this software will become. But I can't even put it into words. I couldn't, for the talent that we have on our team, I couldn't, through prompts or in any way using natural language, explain what it is they do. That's something extra. That recognition of, I've seen this before, this management team can do it. I just have this sense. It's very intuitive, and that's where the art and the science meet, because the science is all quantitative, and it's, here are the numbers, here's the valuation, here's the scenario analysis. But then even if it starts to go wrong initially, hanging in there, to your earlier question, comes from a level of experience that's sort of deep into the psyche of the human, of the great portfolio manager, that I have yet to see, and I very much doubt that will be automated.
If you think about how much has been automated today relative to 50 years ago, and people are still adding value, and it seems like it just raises the bar on the human input that is needed to generate excess returns. And you can imagine the same thing 20 years into the future.
Yes, and I that's why I'm very confident in our team. What we do quantitatively is just powered by innovation. Just the ideas that come out of our analysts are so incredible. And some of it is from what we do fundamentally. So we inspire them. But as I mentioned earlier, fundamental value investing is hard work. It's active. It's roll up the sleeves, get involved with management, understand what's going on at the governance level, at the board. push for what we want, hold them accountable, keep in touch, make sure we understand where the peers are going, it would be very difficult to assign that to machines.
Yeah, and then you also have to trust what the machine says. So that's another level.
That's one of the reasons why in these early days of experimentation with different models and applications on top of the models, we check everything, because any inaccuracies make it all sort of pointless. Like, we could have built it ourselves. If we have to go back and check everything, it's the same amount of time, in fact, more. So developing a level of trust and understanding the origins of data and the validity of it is really important. But I know we'll get there, and I'm not worried about. I'm only concerned about retaining and motivating the human talent that does something that the AI can't do.
A little bit earlier, we talked about a potential inflection point in terms of the investment landscape. What do you see as the most important investment implications if we actually do go through a major inflection point here?
Well, they're all good, because markets don't go up linearly. The U.S. market, though, I have to admit, has delivered returns. If you take me back 15 years and you told me that we're going to get a 14 to 15% annualized return in U.S. dollars from the U.S. market for the last 10 or 15 years, I would have said impossible. That's crazy, way too high. So it's been an amazing ride. But a pullback and a reset, especially if we do have runaway inflation, that brings multiples down. There's just no way around that. And maybe we'll have some really good nominal earnings growth, but a reset is usually quite healthy to get back in the game, so to speak, into companies that might have been in our view, overpriced, or there just wasn't enough return remaining, and upgrade the portfolio in terms of quality. So I think it's healthy and sign of normal equity market activity, where sort of an inexorable rise isn't. It's great. It's just underlying that is a level of asset price inflation that is probably not sustainable.
Yeah, I think also you have to look at returns within the context of the environment that happened to transpire. And we had zero rates for a decade or longer, highly accommodative central banks. And anytime there was a whiff of a downturn, there was even more stimulus, monetarily and fiscally. And so given that backdrop and starting valuations that weren't particularly high coming out of the GFC, it's understandable that market returns were high. But when you look ahead, it's hard to imagine having the same backdrop.
The optimists, I like being an optimist, but I have to be careful in this statement because I can't prove it, would say that the productivity gains ahead are going to be so tremendous that it'll create a whole new level of growth. Perhaps we just need to get there quickly, because between here and there, it could be as I said earlier, a period of disruption and changes in employment that make voters, if you combine that with inflation, extremely unhappy.
Sarah, you've been very generous with your time. I just have one last question. When you think about legacy, what matters more to you? The numbers, the institution you built, or the people and careers you helped shape, and why?
I have to make them pari passu, because they're all interrelated. The numbers create the institution. Without numbers, we don't have clients, and therefore we don't have assets, and then we can't pay anyone. And the people and their careers are all part of creating the numbers and motivating each other. But having an enduring firm, one that goes on long after I'm hiking all day long or whatever I'm going to do when I'm ancient, that would be very exciting. Leaving something behind that's still growing, that's still adapting, and clients still find very satisfying, that would be as good as it gets.
That's wonderful. Sarah, I appreciate you joining us and sharing all your insights with us. Thank you.
Thank you, Alex. It was my pleasure.
Important information. This podcast is provided for informational purposes only. and should not be considered legal, tax, investment, or business advice. It is not a solicitation, recommendation, or endorsement. All opinions expressed by participants are their own and do not necessarily reflect the views of the Evoke Advisors Division of MAI Capital Management, LLC, or Evoke, its affiliates, or any companies mentioned. Information shared has not been independently verified by MAI or its affiliates. MAI Capital Management, LLC, or MAI, is registered with the U.S. Securities and Exchange Commission, SEC, which does not imply any particular level of skill or training. Certain information contained herein has been obtained from third-party sources, and such information has not been independently verified. No representation, warranty, or undertaking, expressed or implied, is given to the accuracy or completeness of such information by any person. While such resources are believed to be reliable, Evoke does not assume any responsibility for the accuracy or completeness of such information. Evoke does not undertake any obligation to update the information contained herein as of any future date. The content is intended for a general audience and does not constitute a recommendation to buy or sell securities or adopt any investment strategy. Any examples or scenarios discussed are illustrative only, involve risks and uncertainties, and do not guarantee future results. Non-traditional assets carry significant risks and may not be suitable for all investors. Decisions should be based on individual objectives, risk tolerance, and circumstances. Statements herein are general and may not reflect an individual's or entity's specific circumstances or applicable laws, which vary by jurisdiction. Further, speakers' views are personal and may differ from Evoke and MAI recommendations and are not specific investment advice, and do not consider client objectives, risk tolerance, and diversification. Guests may have current or past relationships with Evoke and MAI, its affiliates, or the host, including as clients, service providers, or business partners. Participation does not constitute an endorsement or testimonial. No compensation has been paid or received for guest participation unless disclosed. MAI and its affiliates may have business relationships with entities mentioned in this podcast, which could create potential conflicts of interest. These relationships may include advisory services, investment management, or other arrangements. MAI seeks to manage such conflicts consistent with its fiduciary obligations and policies.